If you look at that price right now at 30,000, the first time it traded 30,000 was right at the end of 2020, right at the beginning of 2021. And if you look, so it's unchanged. The NASDAQ over the same period, it's up 20%, yet the volatility of NASDAQ is half that of Bitcoin. So right now, yeah, Bitcoin's great. It's got all this ETF coming on. We have the hopium for the ETF. But if the actual performance versus the NASDAQ, which has got AI and everything going for it, I look at it as I'm disappointed.
In the world of investing, market expectations play a significant role in shaping decisions. However, Mike McGlone emphasizes that it's essential to look beyond mere speculation and observe the macroeconomic landscape. Amidst today's uncertainty, Bitcoin and other cryptocurrencies emerge as serious investment options. McGlone highlights the significance of Bitcoin in the current financial climate, referring to it as digital gold, in which the growing interest and anticipation of BlackRock's ETF approval could propel its value even further. However, the market's bullishness on Bitcoin prompts caution, as its performance goes head-to-head with the Nasdaq and the S&P 500. While Bitcoin presents itself as a promising asset, economic stability and regulation are two of the main driving points that investors observe, as the emergence of stablecoins and digital currencies are pegged to major fiat currencies. Bitcoin's potential this year is unmatched, amidst the evolving landscape of digital currencies and the ever-changing financial markets. Let's get right into the latest interview with Mike McGlone, where he dives into market expectations for 2023 and why Bitcoin and cryptocurrency are significant investments this year. Don't forget to share your thoughts and comments down below and leave a like if you enjoy the content we do here.
Market expectations. You look at the WIRP function on the Bloomberg terminal, it says 92% that they're going to raise another hike on July 26th, and they're going to keep raising. And we're not going to get a cut until March. Now, this is what a lot of economists think, but it doesn't matter so much when the market's already priced for it. So I look at it, it's still simply a fact is the Fed is still taking away liquidity, and most risk assets are expensive, completely expecting this soft landing. And the whole narrative is termed that, oh, we're not going to get a recession, the Fed's still tight and everything's okay. I look at this as one of the most offside markets in history, and the risk reward is just not good. And so if my scenario kicks in, you get the normal reciprocity from all this tightening, and it shows up in the economy, but in a delayed reaction, Bitcoin should want to be the first ones to show it. So right now, the Fed is still going to keep tightening. And what's going to keep them tightening if the stock market keeps going up? It's still that same issue, which is a problem. And I look over at Bitcoin is, yes, I'd love to be bullish Bitcoin, but if you look at that price right now at 30,000, the first time it traded 30,000 was right at the end of 2020, right at the beginning of 2021. So it's unchanged. You look at the NASDAQ over the same period, it's up 20%, yet the volatility of NASDAQ is half that of Bitcoin. So right now, yeah, Bitcoin's great. It's got all this ETF coming on. We have the hopium for the ETF. But if the actual performance versus the NASDAQ, which has got AI and everything going for it, I look at it as I'm disappointed. And I think it's still the problem is I sense so much bullishness, but yet the macro is very unfavorable. The Fed is still taking away the punch bowl. I had to bring up some charts and things I've been focusing on for a while. And that's, first of all, let's start with U.S. new homes under construction. It's the highest ever. I go back to 1969 on this one, and the chart looks just like it did in 2006-07. It double topped and then collapsed. The big difference was back then as the Fed started easing in September 2007. Big difference. And also we have this massive spike in interest rates. Yes, we're freezing up the sell side for people who do not want to sell their home and refinance at a higher rate. But since when is seizing up a market good for it? And another chart it made me bring up is we just look at producer price index, is the year-over-year measure. It's at -3%. It's only happened 3 times in history since 1949. This is the finished goods measure. And it's never happened with the Fed funds rate still rising at, I'm just using a 3-month bill at 5.28% at the moment. This has never happened before. And I look at it as, okay, maybe the whole rules of all the lessons of economics and liquidity and cycles are no longer accurate, which is what I've been doing on my vacation. I've been really enjoying reading and relearning all this financial history stuff I forget on a daily basis. Those are accidents just waiting to happen. Now, PPI at -3% is probably bottoming soon. But the fact that the Fed is still tightening the environment, now we see China, every single piece of data out of China is disappointment. That's a train wreck just getting started. So I look at this as this is the macro. I'm an impatient person, and the market's testing my impatience. But these things take a while. They started dropping the required reserve rate about a decade ago. It's been dropping ever since. They've been pumping liquidity forever. Now we have a housing crisis that's kicking in and unemployment. And on a nose, we hear from my colleagues who are based there, they have to be careful because this is the situation now is you can't put your name into an article on China if you don't want to risk imprisonment. And that's just the way that's the fact. So we're at that stage now. It looks to me, China to me is a combination of peak Japan and peak Soviet Union about 3 decades ago. It's all tilting that way. Quick question I ask is, what changes this current trajectory of disappointment? They have to stimulate, yet they know they can't stimulate much anymore. Locals, I hear the local entities are so over indebted, they have issues. And of course, the housing crisis looks like it's just getting started. Everybody said, I think we can all put together. I definitely agree with Dave about the optionality of Bitcoin and digital gold. And remember, I made the call for 100,000 Bitcoin when it was trading below 20, and we got that in Ethereum. And then, of course, what happened with China. And I still stick with that in the long term, but I think it's more likely to drop 50% and get down to 20, even make a new low before it goes on that trajectory, particularly when I see things like, well, I can get 5.25 in a T-bill, done. I look at the Case-Shiller index, the housing index, it just was almost at the highest ever right before, like 2006, up 20%. Now it's down 1%. That's collapsing. I look at the Fed still tightening. And the last thing that always usually falls is the stock market. Just look at your history. I remember 2006 and 7 was tough, just like Big Short. I was short a lot of stuff and I didn't get paid back until 2008. It's just the way it works and people get stopped up. But there's two things. One thing I want to mention is what's happening with Case-Shiller. Bitcoin, I completely agree, but it has major competition like gold does from the US, the base currency giving you the best rate on the planet and the deepest treasury market. But there's one thing I also want to mention I really enjoyed recently to point out how significant this technology is. We're hearing about Hong Kong maybe lightening up a little bit of their strict regulations, and I heard they might approve a Hong Kong crypto dollar. The Hong Kong dollar is pegged to the US dollar, which means that's a quasi crypto dollar.
It's a dollar stablecoin. So is the Chinese yuan, right?
But
so it shows the digital yuan.
Exactly. It shows how significant this technology has adapted to the US system, to the dollar, organically.
McGlone also emphasizes the importance of considering macroeconomic indicators, particularly those related to the housing market and the price index, to assess potential risks. New homes under construction are at an all-time high, reminiscent of the 2006 to 2007 period before the housing crisis. Coupled with a tightening Fed funds rate, this raises questions about conventional economic models' accuracy. Additionally, China's economic trajectory becomes a major concern, with McGlone drawing parallels to Japan's past and the Soviet Union's peak. China's regulatory landscape and ongoing housing crisis could impact global markets, making investors wary of potential disruptions. He warns against excessive bullishness, citing significant market downturns after periods of irrational excitement. What do you think about the market insights shared in the latest interview with Mike McGlone? And do you believe Bitcoin's trajectory will send the crypto market into a massive rally in the last few months of the year? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.